Thanks again for having me here today. And I'm very happy to be discussing this topic that has become much more mainstream beyond the green investing circles. And I think it's an exclamation point on it with our first, or what I've seen, our first green hydrogen ETF being launched this week, as well as the announcement about the Saudi green hydrogen plant making front page news on the Wall Street Journal. So if I just take a step back on your question on what will make hydrogen economically attractive, I'm going to take this in two parts. It's what's going to be focused on what does the future production cost curve need to look like for hydrogen to become more attractive, and how we're seeing it play out in the investment space, particularly within our energy transition as well as climate change strategies we have here at Schroders. As everybody on this line knows, 95% of the hydrogen market today is made up of that exceptionally polluting but cheap gray hydrogen. We all know, and this is the crux of the question, is how much more expensive renewable hydrogen is by fossil fuels. But the good news for everybody and everybody on this call is that by 2030, renewable hydrogen should cross over and become the cheapest method of production, at which point there is really no need to persist those alternative uses. And while over the long term, we are believers in green hydrogen becoming the most economically viable option, we're nowhere near that right now, which is why we're having this conversation. And keys to reducing that cost of hydrogen is really in the electrolyzer market. And that's where we're seeing that key to really reducing that. Because in order to produce gray hydrogen right now, we're looking at $1 to $2 a kilogram. Whereas green hydrogen, we're sitting at $5 to $7 a kilogram. And while we're seeing a more attractive price coming out through China of around $200 a kilowatt, even using that price, we're still sitting at $3 to $4. So you're not really competing still over the short term. But one area that we're watching really closely and we think has a significant opportunity and potential to disrupt the market, especially when you factor in those lower electrolyzer prices, is blue hydrogen. So hydrogen using natural gas and carbon capture storage. And we think that delivering it this way can be at a cost of $2 to $3 a kilogram. And why are we watching this space so closely? Well, the answer is who are the most obvious companies to go into that market? And that's really those traditional oil and gas companies. And what we're seeing amongst them is a lot of them are forming alliances to really get into this space. So from the investment perspective, the easiest way to play it really is the electrolyzer market. But we are actually very concerned and cautious, particularly around the hydrogen listed equity names. The valuations that they have exploded to are massive. And these are companies that really don't have much underlying profit. And then if you factor in those cost dynamics of the hydrogen market, which these companies are pricing in that much cheaper electrolyzer parts by 2030, if you factor those in alongside increasing competition from oil and gas, they're really priced to perfection right now. In terms of looking at the global market, what we're seeing out there is Japan and Europe really being the leaders within hydrogen power. And actually our data insights unit, which is our big data team, did some interesting work. And what they did was look at, they used alternative data to analyze the patent registration coming from companies around hydrogen power. And they found that the top three were all Japanese firms. So although Europe tends to get a lot of the headlines, we even had a fund manager write, is decarbonization the trend of the future, and why European markets were posed to outperform US markets. Actually, the top three firms in terms of decarbonization and hydrogen are all located in Japan. So there's a lot of favorable dynamic market backdrops that we're watching really closely. However, in terms of an investment perspective, we are super concerned about the valuations that are going through some of these prices, through some of these companies that are really focused on that electrolyzer as well as the green hydrogen market across the value chain. But we do think it's a super exciting space as we continue to see that cost curve from the production of green hydrogen, plus the alliances forming by big oil and gas around blue hydrogen, It's an area that we're excited about and continue to look for investment opportunities across the value chain, maybe not the sort of most obvious winners and losers. I think this is something we've seen not just with hydrogen, we've seen it happening with many companies, both here and abroad, and it's part of what the EU Sustainable Finance Bill really hits home at. Both for asset managers as well as the companies we're invested in, is this concept of greenwashing that we're seeing happening out in the market, really hitting Scott on the head of what you are addressing there. I think the positive news is that many institutional investors, large asset owners, as well as asset managers like ourselves, we're definitely onto this. And although they may have this great marketing campaign to the general public, I think we can sort of all rest assured that while policy is still coming up, and policy tends to always lag behind, you have large institutional investors here in the US, as well as asset managers that are really beginning to question that. And Schroders, we were one of the founding signatories of the Asset Managers Alliance for Net Zero. This is a big aspect of that, not only pledging a certain amount of pledging all of our assets to be net zero by 2050, but also hitting interim targets as well. But alongside of that comes with working with other asset managers for cases just like this, identifying the laggards and really digging into that data, engaging with them, asking those critical questions. We are a divest at last resort company. We tend to want to work with these and influence change. But I also think you're seeing momentum around divestment globally as well, particularly out of Europe. And I don't know how much the individuals on this call are watching Europe, but the EU has put their flag in the ground, not only to be the global leader in sustainable finance and sustainable finance disclosures, but within that taxonomy, the second level, the next leg to drop of that is aggressively motivating capital towards green industry and away from dirty or brown industry.